You've been lied to about trading edges. Everyone chases the next holy grail indicator, the secret strategy, the AI bot that prints money. But here's the brutal truth. 97% of day traders lose everything within a year, not because strategies suck, but because your brain is wired to sabotage every edge you find. Think about it. Free strategies flood Reddit and YouTube, yet you blow accounts. Why? Your amygdala hijacks logic on losses, turning smart plans into revenge trades. I've coached traders through 100 plus blowups. Same pattern every time. Genius like Jesse Livermore made fortunes, then emotionally nuked them 3 times, dying broke. The only edge that actually matters: ruthless psychological discipline. Master one simple process: tiny risks, extreme patience, zero emotional interference, and watch consistent profits stack up. No hype, just boring wins that compound. You're not stupid, you're human. But humans lose at trading until you beat your wiring. So why do even geniuses fail? Let's break it down, starting with the big lie everyone believes. You chase that next indicator on TradingView, the fancy EMA crossover, the RSI divergence everyone's hyping on Reddit. Or maybe you forked over $500 for some proprietary algo from a guru's Discord. Here's the thing. Every single one of those is already public knowledge. Google it. It's on YouTube for free. A 2019 study from the Brazilian CVM found 97% of day traders lose money over a year, not because the tools suck, but because you can't stick to them when your heart's racing. Picture this. You're that struggling beginner staring at your screen. A hot tip from X pops up. Some stock gapping on news. You risk 2% of your account, bigger than your rules say. It wins. Boom. Dopamine floods your brain like winning the lottery. Feels like genius, so you double down next time. Market flips. Loss 1. You move your stop, hoping. Loss 2. Now it's personal. Revenge trade. Risk 5%. Accounts down 10% in an hour. Sound familiar? That's not bad luck. That's your wiring demanding action, screaming, do something to avoid the pain of sitting still. Strategies are table stakes, man. Everyone's got access. LTCM had Nobel-winning physicists and blew up 4PY's $6 billion in 1998 because they ignored risk when emotions kicked in. Retail traders, same story, smaller scale. You think you need a secret edge? Nah, the real multiplier is execution. Ruthless adherence when 90% bail. Your brain's hardwired for overtrading, chasing dopamine hits from clicks over quiet patience. It evolved for saber-toothed tigers, not probabilistic edges where no trade is the best trade 70% of the time. Stakes are brutal. Without discipline, even a 60% win rate setup with 1-to-1 risk reward turns into a money pit because you revenge trade the 40% losers into monsters. Stick around. I'll show you the math proving why waiting crushes predicting and a Nobel winner who bet against it and lost everything. Here's the thing. Strategies are table stakes. Your real edge? Psychology. Let's dive into insight number 1. Insight number 1, strategies are table stakes. Yeah, you heard that right. Every viable edge, RSI divergences, moving average crossovers, fair value gaps, order blocks, you can download it free on TradingView, YouTube, or some Reddit guru's PDF. 99% of what's profitable is already public. The differentiator, not the strategy. It's your adherence rate. How long do you stick to it before your brain hijacks the wheel? Think about it. A 2019 study by Brazil's securities regulator, CVM, tracked day traders over 300 days. Result? 97% lost money, not because their strategies sucked. These folks had access to the same tools as pros. No, It was emotions. FOMO jumping in too early, greed holding winners too long, fear moving stops. You're in that 97% right now, aren't you? Scrolling X for the next alpha, tweaking indicators like it'll save your account. Wasted effort. Let me paint the picture with a real blown-up trader I know. Call him Mike. Struggling retail guy, 10 cole 10 colas $, prop challenge. Downloads a shiny RSI divergent script. Backtests it perfectly on weekends. Monday hits. First setup on SPY. Perfect entry. It goes his way plus 1R. Feels like a god. Second trade, market chops. He adds to the loser, averaging down. Third, revenge after a stop out. Risks 3% instead of 0.5%. Poof, account to zero in 2 weeks. Mike's not dumb, he's wired like you and me, craving action over process. Here's the rule of 3 that crushes it. Markets boil down to probability plus process plus psychology. Nail probability with a simple setup, check. Lock in process with rules, maybe. Ignore psychology, 0 edge, every time. Jack Schwager's Market Wizards interviews hammer this home. Top traders like Paul Tudor Jones didn't win with secret sauce. They won by executing mechanically when everyone else panicked. You feel that frustration? Pouring hours into Pine Script, hunting holy grails, only to blow up on tilt. I get it. I've been Mike, blew 2 accounts chasing better edges. But here's what nobody tells you. Even a perfect strategy, a 60% win rate mean reversion play, fails without psychological glue. One emotional slip and your expectancy evaporates. But even perfect strategies fail without patience. Coming up, why boring beats busy and the math proving waiting compounds faster than prediction. Stick around. You won't believe how tiny risks turn losers into quiet winners. You think you're being productive, staring at charts all day, forcing trades just to stay in the game. But here's the brutal truth. Overtrading isn't hustle, it's suicide. You're not a machine gun spraying bullets. You're a sniper. And snipers wait days for one perfect shot. Picture this. Trader A forces a trade every day on whatever looks decent. B or C setups in choppy markets. He hits maybe 40% winners at 1 to 1 risk reward. After 100 trades, he's down 20% on his account, thanks to those sneaky losers piling up. Sound familiar? That's you on most weeks, right? Heart racing, FOMO, kicking in because the market's ranging sideways. 80% of the time, like Van Tharp hammered home in his books, markets trend just 20 to 30%. The rest, boring consolidation, but you can't sit still. Now Trader B, she waits for a plus setups only, 1 or 2 a week. Crystal clear confluences, your one mastered pattern aligning perfectly. 55% win rate, same 1 to 1 RR. Just 20 trades a year, up 10% compounded. No stress, no tilt. Her edge? Patience. Not prediction. Let me crunch the numbers quick so you see it. Say 1% risk per trade. Selective, 11 wins at plus 1%, 9 losses at minus 1%. Net plus 2% per 20 trades. Overtrade to 100, win rate drops to 40% from emotion. 60 losses crush you to minus 20%. Expectancy flips negative. Boom. Account gone. You felt that guilt, haven't you? I need more trades to make it work. Wrong. Boring wins. Van Tharp called it. In ranging hell, selectivity is your moat. Pros don't predict. They pounce on probabilities. This selectivity saved Paul Tudor Jones from disaster in Black Monday '87. His story hits next, and it'll blow your mind. But patience alone craves tiny risks to survive those inevitable streaks. 5 losses in a row happens 10% of the time, even at 60% win rate. Without small size, you're toast. Coming up, how micro positions build unbreakable edges and tease the Kelly criterion math that pros swear by. Stick with me. This changes everything. Imagine this. You're staring at your screen after that fifth loss in a row. Heart pounding. Equity curve in free fall. But what if your positions were so tiny, those losers barely dented you? That's the power of micro risks, not 1% or 2% like the gurus scream. I'm talking 0.25% per trade, or even 0.1%. Here's the math that'll free your brain. At 0.25% risk, you could absorb 400 straight losses before ruin. 400. Yeah, impossible streak, but even 20 in a row? You're down just 5%. Sleep like a baby. Compare that to 2% risk, the amateur trap. 50 losses wipe you out. And guess what? At a solid 55% win rate, 5 losers hit 10% of the time. 10? Once a year, easy. Your account? Vaporized. You fear small wins, don't you? That's chump change. I need real money. Wrong. Tiny size starves the dopamine beast. No more P&L roller coaster hijacking your prefrontal cortex. No amygdala freakouts. Screaming, double down. Instead, you obsess over process. Did I follow rules? Set up a plus. Journal clean? That's your high now. Enter the Kelly criterion. The math pros, like Ed Thorpe, swear by. For us retail mortals, under 60% accuracy. It spits out 0.1, 0.5% optimal risk. Overbet and variance murders you. Underbet, you compound slow but sure. Think casino house edge. They risk pennies on millions of bets. You grind the same. Take Sarah, a quiet pro I followed on X. Started at prop firms, failing challenges left and right with 1% risks. Switched to 0.1%, survived a brutal 100 tray skid, 2 years of pain, no blow up, no tilt. Now, 15% yearly, scaling up as confidence builds. She posts charts, flatlines during hell weeks, steady creeps up. Boring saved me, she says. You've chased big swings, haven't you? Felt alive on winners, dead on losers. Tiny risks flip that. Survival becomes sexy. Your brain rewires, I can't lose big anymore. Discipline locks in. No revenge, no FOMO, sizing up. But here's the thing. Tiny risks demand ruthless consistency. One slip and emotions creep back. Tweak that stop, you're cooked. Coming up, why endless optimization destroys more accounts than bad setups ever will. Stick around, this is where most quit. Endless optimization. That's the silent account assassin. You scour TradingView for the next holy grail. RSI divergences, Fibonacci clusters, AI-powered volume profiles. Your demo account lights up with backtests. This time, it's perfect. But live, you tweak, you add filters, you chase shiny upgrades. Result, paralysis. Or worse, overtrading a Frankenstein system that works nowhere. Here's the brutal truth. The only edge that crushes is ruthless consistency on one dead simple setup, not 10 half-baked strategies. 1. Master it like a sniper masters his rifle. Picture this. The two pull back on the daily 28. Price respects it twice. Volume confirms you enter with a tight stop below the low. That's it. No news catalysts, no moon phases. Run 100 paper trades. Then 100 microlot lives feel the rhythm. Your brain rewires from hunter-gatherer chaos to machine like precision. Jack Schwager nailed it in Market Wizards. Ed Seykota, trend-following legend, turned $5,000 into $15 million sticking to one system. 1. He ignored the noise. Futures, currencies, whatever's hot. Seykota said, systems don't need to be changed. The trick is for a trader to develop a system with which he is compatible. Compatibility, adherence, not endless upgrades. You feel overwhelmed, right? Forums screaming, diversify setups. Brokers pushing indicators. Reddit threads on edge stacking. It's a dopamine trap. Every better idea pulls you from mastery. Think lion hunting analogy. The king doesn't chase every gazelle. He waits for the perfect stalk. One kill, perfectly executed, feeds him for days. You spraying machine gun trades at shadows, starving. Relief hits when you commit. Pick your setup today. Journal every rep. Entry rule. Risk 0.1%. Exit clean. After 50 trades, patterns emerge not from complexity, but repetition. Wins cluster. Losses shrink. Confidence builds. No more what-if regret. Traders on X confess it daily. Mastered one pattern, finally profitable. Social proof everywhere, but consistency fights emotions. Your brain still sabotages with just one tweak. Why? fMRI studies show your prefrontal cortex lights up on novelty, craves the new. Coming up, how emotional control turns that sabotage into your asymmetric edge. Hang tight. This flips everything. Your brain craves action. It dodges pain like a caveman fleeing a saber tooth. That's why you hold losers, praying for a turnaround while cutting winners too soon. Sound familiar? It's not weakness, it's wiring. Amateurs chase dopamine from trades. Any trades. Pros. They flip it. Cut losses fast. Let winners breathe. That asymmetry, it's your untapped edge. Think about it. fMRI scans from Kunin and Knudsen in 2005 lit this up. Under stress, your prefrontal cortex, the logic center, goes dark. Emotions hijack the wheel. You feel the trade will reverse. Logic whispers, cut it. But amygdala screams louder. Result? Tilted decisions. Bleed out accounts. Here's the counter-argument I hear nonstop. But I need to adjust stops. Markets change, bull. Adjusting mid-trade. That's hope, not discipline. Pros don't. Paul Tudor Jones crushed it proving this. 1987. Black Monday loomed. Valuations screamed bubble. He shorted futures hard, risking just 1% per idea. Markets tanked 22% in a day. His fund up 200% that year. How? Losers average losers, he said. No averaging down, no moving stops, ruthless cuts on wrongs. Winners ran free. One emotional edge beat the herd's panic. You versus them, amateurs spray trades like machine guns, hoping for hits. Pros, snipers. One disciplined shot. Tension builds in your chest after a loss, heart racing, screen glaring. That's betrayal, but imagine flipping it. Feel the power when you cut clean, no second guessing. Accounts grow steady, no more weekends wrecked by drawdowns. This control, it turns sabotage into supremacy. Every pro swears by it. Retail forums echo the pain, tilted again after 2 reds. But you can break free. Control emotions with journaling and no trade days. Tools that reveal your true edge. Stick around. These drills make it stick. Let's get real about sealing this edge. You know, that journaling isn't some fluffy diary entry. It's your brutal truth serum. Every trade, log it raw. What setup? Did you follow rules? Emotions firing. Funnel, revenge itch. Brett Steenbarger nailed it in his 2009 research on elite traders. Those who journaled emotions and adherence saw win rates jump 15 to 20%. Why? You spot patterns your brain hides, that gut feel pulling you into losers. Exposed. No more denial. Picture this. You're staring at your screen after